What if you could act like a bank, lending money to real people and earning interest, without a Wall Street suit? Peer-to-peer lending promises passive income, but is it a golden opportunity or a risky gamble? Let's find out if it's right for you. What is peer-to-peer lending? Peer-to-peer, P2P, lending is like cutting out the middleman in banking. Through online platforms like LendingClub or Prosper, you lend money directly to individuals or small businesses, earning interest as they repay. It's a way to generate passive income, with average returns of 5 to 9% annually, per 2023 data from P2P market data. Take Aisha, a 30-year-old teacher with $3,000 to invest. She's intrigued by P2P's promise of steady returns without stock market volatility. Instead of depositing cash in a 1% savings account, she lends it to borrowers vetted by platforms, earning 6% interest. It works like this. Borrowers apply for loans, say for debt consolidation or home repairs. Platforms assign risk grades, A to E, based on credit scores. Aisha picks loans, diversifying across dozens to spread risk. Payments, including interest, flow back monthly. Emotionally, it's empowering. She's helping people while growing her money. But it's not risk-free. Borrowers can default. A 2022 LendingClub report showed default rates of 4 to 6% for riskier loans. Aisha starts small, using platforms' auto-invest tools to diversify, balancing reward with caution. Practically, sign up on a platform, link a bank account, and start with as little as $25 per loan. It's accessible, but research is key. Check platform fees, 1 to 2%, and borrower profiles. Pros: high returns compared to savings. P2P lending often beats traditional savings or bonds. While high-yield savings accounts offered 3 to 4% in 2023, P2P platforms averaged 7% for diversified portfolios, per Prosper data. For conservative investors, sticking to A/B grade loans can yield 4 to 6% with lower risk. For example, Liam, a 28-year-old barista, invests $2,000 across 80 loans at $25 each. His portfolio yields 6.5%, earning $130 yearly, far above his bank's 1%. Over 5 years, that's $650 in interest, assuming minimal defaults. Compounding boosts returns. Reinvesting payments buys more loans. Liam uses LendingClub's auto-reinvest feature, growing his portfolio without extra effort. Emotionally, it feels like running a mini-bank, generating cash flow while he works. Tax-wise, interest is taxable, but Liam offsets this by investing in an IRA, deferring taxes. Platforms provide tax forms, simplifying filings. He checks X for user reviews, confirming platform reliability. Practically, aim for 50-plus loans to diversify. Use platforms' risk filters to match your comfort level. Higher yields mean higher risk. Liam's strategy blends steady income with calculated risk. Pros: accessibility and flexibility. P2P lending is open to almost anyone with a few $100. Unlike real estate's high entry costs, you can start with $500. Platforms like Funding Circle allow investments in small businesses, broadening options. Sophia, a 35-year-old nurse, likes P2P's flexibility. She invests $1,000, splitting it across consumer and business loans. She can adjust her risk, choosing safer A-grade loans or riskier D-grade for higher returns. A 2023 Funding Circle report showed business loans averaged 8% returns, appealing to her growth goals. Liquidity is another perk. Some platforms offer secondary markets to sell loans, unlike real estate's months-long sales. Sophia sells a loan in a week when she needs cash, though at a slight discount. This flexibility feels freeing, fitting her unpredictable schedule. She uses platforms' dashboards to track payments, seeing real-time returns. Emotional connection. She's funding dreams like a small bakery's expansion. Sophia researches borrower stories on platforms, picking loans with purpose, blending profit with impact. Practically, start with a small test, $100 across 4 loans. Monitor repayment rates and adjust. Sophia's cautious entry builds confidence without overcommitting. Pros: diversification beyond stocks. P2P lending diversifies your portfolio, uncorrelated with stocks or real estate. During 2022's stock market dip, P2P returns held steady at 5 to 7% per P2P market data, offering stability. Noah, a 31-year-old freelancer, adds $2,500 in P2P loans to his stock-heavy portfolio. When tech stocks fell 20%, his P2P income cushioned losses, providing monthly cash flow. A 2021 Morningstar study noted alternative investments like P2P reduce portfolio volatility by 10%. It's also inflation-resistant. Loan interest rates often rise with inflation, unlike fixed bonds. Noah's loans, tied to variable rates, adjust upward in 2023's 6% inflation environment, preserving value. Emotionally, it's reassuring. Diversification feels like a safety net. Noah uses platforms like PeerStreet for real estate-backed loans, adding another layer of variety. He checks X for investor sentiment, ensuring his platforms are trusted. Practically, allocate 5 to 10% of your portfolio to P2P initially. Noah balances with stocks and ETFs, using apps like Personal Capital to track overall performance. Cons: risk of borrower default. Default risk is P2P's biggest hurdle. If borrowers don't repay, you lose principal and interest. In 2022, Prosper reported 5% default rates on C-grade loans, higher for riskier grades. Elena, a 29-year-old teacher, invests $1,500 across 60 loans. 2 borrowers default, costing $50. Her diversified portfolio limits the hit, but it stings. Platforms don't guarantee losses. Unlike FDIC-insured savings, your capital's at risk. Emotionally, defaults feel like betrayal, but Elena learns to expect them. She sticks to A/B grade loans, with 2 to 3% default rates, per Lending Club data. Historical trends: diversified portfolios recover losses through interest over time. Mitigate by spreading investments. 100+ loans is ideal. Elena uses AutoInvest to diversify, checking platforms' recovery processes. Some pursue collections. She avoids high-risk loans unless comfortable with volatility. Practically, review loan grades and borrower credit scores. Elena sets a 700+ credit score filter, balancing safety with returns. Cons: lack of liquidity. P2P loans aren't as liquid as stocks. You're often locked in for 3 to 5 years. Secondary markets exist, but selling loans can mean discounts or fees. In 2023, Lending Club's secondary market saw 5 to 10% discounts on loan sales, per user reports on X. David, a 33-year-old engineer, invests $2,000 but needs cash after a year. Selling his loans nets $1,800 after fees, a 10% loss. This illiquidity feels restrictive, especially in emergencies. Some platforms like Prosper offer faster exits, but liquidity varies. David learns to keep P2P as a long-term play, holding emergency funds elsewhere. Emotional toll: planning for lock-in reduces stress. Mitigate by investing only what you can tie up. David allocates 10% of his savings, keeping the rest liquid. He researches platforms with active secondary markets, easing future exits. Practically, check loan terms. Shorter 1 to 2 year loans offer more flexibility. David uses platforms' liquidity guides to plan, aligning with his financial need. Cons: platform and regulatory risk. P2P platforms aren't banks. Some have failed, like Lending Club's 2016 scandal, shaking investor trust. Regulatory changes, like stricter lending rules, can disrupt returns. A 2022 SEC review tightened P2P oversight, impacting loan availability. Mia, a 27-year-old freelancer, invests $1,000 in Prosper. A platform glitch delays payments, sparking worry. She checks X, seeing mixed user reviews, and diversifies across Lending Club to reduce platform risk. Emotional weight. Trusting a platform feels like a leap. Mia researches ratings on Trustpilot, picking established players with strong track record. A 2023 P2P market data report showed top platforms had 99% uptime, boosting confidence. Mitigate by choosing platforms with 5+ years of history and transparent fees. Mia spreads $500 across 2 platforms, limiting exposure. She monitors regulatory news via X, staying ahead of shift. Practically, read platform terms. Check bankruptcy protections. Mia ensures her investments are in diversified notes, not single loans, for added security. Building a P2P lending strategy. Craft a strategy matching your risk tolerance and goals. Want safety? Stick to A/B grade loans for 4 to 6% returns. Seeking growth? Mix in C grade for 8 to 10%. Start small, $500 across 20 loans. Sophia, a 40-year-old consultant, invests $3,000, splitting 70% in low-risk loans, 30% in higher-yield ones. She uses auto-invest for ease, targeting 6.5% returns. A 2023 Prosper study showed diversified strategies cut default impact by 50%. Set a time horizon. 3 to 5 years is typical. Sophia reinvests returns, compounding gains. She tracks via platforms' dashboards, adjusting if defaults rise. Emotional boost. Seeing monthly payments feels like clockwork. Research platforms' fees and loan type. Sophia picks Lending Club for low fees, 1%, and business loans for variety. She follows X for user tips, refining her approach. Practically, use risk calculators from platforms to project returns. Sophia's disciplined mix balances income with peace of mind. Monitoring and adjusting your P2P portfolio. P2P requires periodic check-ins, not daily stress. Review monthly. Are loans repaying? Are defaults within expected 3 to 5%? Platforms like Lending Club provide real-time dashboard. Liam, a 31-year-old nurse, tracks his $2,000 portfolio. When defaults hit 6%, he shifts to safer loans, boosting stability. A 2022 Morningstar study showed active P2P management improved returns by 1%. Adjust for life needs. Liam takes interest as cash when saving for a car, then reinvests later. Monitor platform health via X. User complaints can signal trouble. Use tools like Mint to track overall finances, ensuring P2P fit. Liam's routine, checking monthly, tweaking risk, keeps his income steady and stress low. Peer-to-peer lending offers high returns, accessibility, and diversification, but defaults, illiquidity, and platform risks are real. We've covered picking loans, managing risks, and building a strategy that works for you. Start small. Try $100 across a few loans, and see if P2P fits your path to passive income. Action now builds wealth later. Check the description or pinned comment for free P2P tools and exclusive platform recommendations to get started. Since you're still here, YouTube's picked the perfect next video for you. It's on screen now, so keep exploring.